Welcome back to an overnight accountant's course on realtors and taxation, where our goal is to minimize your largest expense, your taxes. In this section, we're going to be discussing something that is absolutely vital to help you minimize those taxes and keep those taxes minimized, not only to minimize them as you're preparing your return, but to have proof later in case the IRS wants to see it, so you can keep those deductions. So, record keeping and proving deductions. That's the title of this section. Let's talk about the importance of record keeping. Record keeping, well, first let's go, what does record keeping mean? What we mean when we say record keeping is maintaining a history of transactions so that you are able to prove your deductions. Maintaining a history so later you can prove your deductions, also so you can take your deductions at the end of the year for your personal use and also to prove your deductions. So in taxation, you may not realize this, but in taxation, the rules are a little different than, say, criminal court, like, innocent until proven guilty in the United States. However, that's not really the case for taxes. If you're claiming a deduction on your tax return, the IRS would want to know, or want for you to have proof so that you are entitled to that deduction. So the burden of proof is on the taxpayer to substantiate any deductions you may have. And that is why record keeping is so important. If you don't have proof of a deduction and the IRS looks at it, chances are no proof, that deduction will be disallowed. And disallowing a deduction, you know what that means? You're going to owe the back taxes. You're also going to owe the penalty. You're also going to owe interest. Now, if it's a large deduction, you can even have even more severe penalties come into play. That isn't the purpose of this course to discuss these penalties, but I want to make sure you're aware of the fact that if you don't have the ability to take a deduction, or if you don't have the ability to substantiate a deduction, you probably shouldn't be taking that deduction. In addition, most tax pros really should not be taking deduction if they know for a fact that you don't have proof or a way to substantiate that deduction. If you're going to somebody prepare your taxes where they know that you lost your receipts or you have no idea, and they don't give you a good discussion about it, or have you find some type of way to substantiate that deduction, you probably shouldn't be seeing that tax professional. So just want to make sure you're aware of that. However, poor record keeping and poor record-keeping habits cost business owners a ton of money. And that is why we are starting this course out with the importance of record-keeping. At least it's in the front section of the course. We want to show you how much taxes you're owing. And now we want to make sure you have the records to prove your deductions. And you don't lose a ton of money because you don't necessarily have receipts the IRS looks at you. You lose a ton of money because you haven't kept records throughout the year. And by the end of the year, you've forgotten about certain deductions you can take because you don't have a contemporaneous record or some type of record showing where your money was spent. You lost your receipts over the course of the year. And for most, I know this for a fact, most of the time, if you don't keep records during the year, I know this from clients I've worked with for many, many years, and you just kind of scrounge around, or last minute you go crazy, in February or March trying to find all your receipts and organize your paperwork, you may have a lot of kid stuff going on, family stuff going on. You may have business stuff. You may have closings to deal with and clients to deal with, and you just don't have time to try to organize all that data at the end of the year, either prepare your own taxes or to have somebody else prepare them. What's the result? You lose a ton of money simply because you didn't keep records, adequate records through the year to help yourself. And that's very, very important. Now, on the flip side, you need to be able to prove deductions. Good record keeping will help you prove your deductions. And what we mean by that is physical evidence showing the following: the date of an expense or something you're claiming as a deduction, the amount of that expense, how much money you spent on that item, the character of that expense, and what we mean by characters, what was the money spent for? Why does it have a business purpose? And also we need to have proof that the payment was paid by you, that you actually made the payment. It wasn't your neighbor's receipt that you're turning in. So we have some kind of evidence to show that. One of the easiest ways to show that is to have a receipt listing the seller's name and address, the date purchased, the items purchased, and your method of payment. So what you purchased, the date you purchased, who you purchased it from, and how you paid for it. And what we want to be able to do is you need to tie it into something else to prove that not only you have the listing, a receipt listing of seller, date, items, and nature of expense, but you also need to be able to prove, very important, that you actually are the individual who made the payment. You actually incurred the economic cost of whatever you purchased. That can be through a canceled check. Ideally, it would actually be on the receipt, but as we know, many places we go, they often don't list your name and address on the receipt. But you want to be able to prove somehow you made the payment that ties to that receipt. Cancel check, bank statement showing the debit. Maybe you have a credit card statement showing the charge. The amount of the charge on the same date ties into the receipt. So that's some easy ways to prove that you made the payment. Additional proof, however, is going to be needed for if you go on a business trip. So you travel for business, there's some additional proof you need. You also need additional proof for meals and entertainment. For some business trips, and that includes travel, you need to show the time and the place of the travel, or time and place of the meal, and the business purpose of the trip. So either you're taking auto mileage, we'll discuss that in a second, or you say you took a trip to go to a seminar, you need the business purpose of the trip. Also, you need to show if you have meals and entertainment deduction, so you take a client out to dinner, or you take them to a ball game or whatever. We'll go over that in detail in the meals and entertainment section. However, you also need to show the relationship with that individual. Now, the good news here is we go through this, and we're talking about auto a little bit. When we go over these deductions, we will once again visit the proof you need to prove those deductions. But I just want to make sure you're aware of what you do need and the importance of record keeping. Auto use, big expense for realtors. Most of the realtors I've worked with over the years, it is literally their largest deduction. And you need to be able to prove that deduction. You need to have a mileage log or register proving the miles that you drove. Also, you need to have the date and time of travel. The dates you drove, and it was in the morning, was it night, it doesn't have to spell specific times, but when did you drive, and the approximate time that you drove. Where you started and where you stopped. Some of the information you're going to need for auto again. Now, in the business purpose of the trip, you want to take a deduction, you better have been doing a showing, you better have been doing something, or picking up supplies. Again, we'll go over detail when we get to the deductions, but I'm just showing you what you need to know to prove your deductions as we go forward. So there's a little bit of information of what you're going to need to prove your deductions. Now let's go into some easy record-keeping suggestions. What I want to do is help you make this easy. Remember, our job isn't to turn you into an accountant. Our job is to help you record the items you're entitled to deduct, so later in the year you can prepare your taxes, but also have proof that you actually incurred these costs and are entitled to deduct them. So here's some easy record-keeping tips, I guess I would say. Always use a separate checking account for your business. If you don't mix your personal money with your business money. Always keep a separate checking account for business and make sure you spend from that account for everything you purchase. Deposit every single commission check into that account. Have all your expenses preferably come from that account, if at all possible. Write checks for those. I'll discuss that a little bit more. Tax tip, another separate account for tax savings. Here's another tip for you, is to have a separate account set up where at the end of the month or every quarter or every time you get a commission check, you set a certain amount of money into that account to help you pay for taxes at the end of the year. One recommendation I would make is that you put 20% of your gross commissions into that account just to be safe for taxes, or you take 35% of your profit into that savings account. And when I have here the term profit in quotes, an easy gauge for that is, say you had $1,000 in the account at the beginning of the month, and at the end of the month you had $3,000 in the account. That means basically after your expenses, you just had $2,000 of quote-unquote profit. So take 35% of that was left over and stick it in that savings account to make sure you're covered on taxes. However, remember, you may have to make estimated tax payments each quarter, so have those estimated tax payments also come from that account. The good news, though, if you do this, let me back up for a second. If you do this at the end of the year, you're going to be covered for your taxes, and you probably will, hopefully, you'll have some money left over to go on vacation or do something with. So it's like a little double savings account, taxes and then you personally. Okay, use checks as much as possible. The reason I like to have checks is because it gives a really good paper trail, and you can often get a copy of that check front and back if you need to. Write items or business purpose on the memo of the check if it's a questionable purchase. So if you're going somewhere, because this will actually back up if you lose a receipt. You see what I'm doing? I'm trying to create some redundancies. If you purchase something for a check, say you write something for a check to your Amazon credit card or something, write what that was for. Hopefully it'll back up. Your Amazon credit card will also show whatever you wrote the check for. If you lose a receipt from Amazon, let's say, the memo of the check will at least help substantiate to a certain extent that deduction. Only use one credit card for business. This is very important for several reasons. We'll discuss this in more detail when we get to your interest deduction, but only use one credit card for business. If you're going to use a credit card at all, just use one for your business. Don't mix it with your personal. If you mix that credit card with your personal items, not only is it very difficult for you to track in an easy manner, either contemporaneously or later, the money you spent for your business, but also if you have any interest on that card or you're carrying a balance, very difficult, if not impossible, to figure out, well, how much of that interest is deductible in my tax return, because there's very complex rules with that. We won't cover them in this course. So, to the safe side, we'll discuss it later. One credit card. If you're using one, try to use only one card. Only use it for business. Online banking. Record business purpose as much as possible. So if you're able to do online banking through your business account, hopefully there's somewhere in the memo or something you can write, well, what was this for? So later you know in detail what that purchase was for. Online purchases. You may use the site. If you make a lot of online purchases like I do, make sure you're using a website or an online provider that you can actually later look up the items you purchased and reprint your receipts. That's very helpful if you ever need it. Do not commingle business and personal purchases. And what I mean by that, if you go to the store and you say you're going to get some groceries, but you say, oh, I need paper for the office, you know what happens? You put that on one purchase, you pay from your personal account. I'm not going to completely guarantee you, but the chances are you're going to forget about that deduction and lose it. And that $10 you spent is going to cost you between $3 and $5 in additional tax simply because you didn't take the time to make that payment with a separate credit card, your business credit card, your debit card for your business, or whatever. Okay, print all receipts for online purchases and payments. Make sure you print the receipts for that. Now here's a tip that I've used for years for myself until we got too big to use it, but also have a lot of contractors use this and realtors. It really works out well for them. This is what I want you to do. All right, get yourself a couple large manila envelopes. I'm talking like the 10 by 13 or something like that. I want you to have one in your car and then have one in your home office or your office, wherever you do your business at. So you have that large manila envelope. What I want you to do is use one envelope for each month. I want you to write the month and the year on the outside of the envelope. So as you gather receipts, you put all receipts into that envelope, be it in your car or be it in your office. If you have it in your car, that way it's always there. Okay, you got something stored, stick it in that envelope. You can't lose it that way. Put all receipts in the envelope. Record receipts for at least once per month. I want you to go through those receipts and I want you to record those receipts. Write them down on something. We'll go to that in a second. But you can record in a column ledger, which is very simple to buy at any office store. Or you can create a simple spreadsheet. Now, if we don't yet, check our website because we may have a sample spreadsheet for you to use. Now, what you want to do when you're doing this is make each column a different deduction category you can total later, and you can take your Schedule C and use the major deductions to create those columns. Check resources section, as I just said, for a sample spreadsheet, and we may even have a separate class on this available to you for some basic bookkeeping for your, when your business is smaller. Here's a sample of what I'm discussing here. As you can see, if you're looking at this here in the ledger, you have the dates, then you have the method of payment. You can see the debit card, Visa, online. You have who you purchased it from. You have a description of what you purchased. And then also you have the amount. And you'll notice here the amount totals here. And then you have the columns. What were they for? Now you have a total here because then you total them all the way over here in this column on this end, and it gives you a match. So that's basically something very simple. As you can see, this is Jane's real estate expense column ledger. It's a little spreadsheet, but you can do the same thing with, preferably buy a ledger from a store if you're not really computer literate, or go to Excel or spreadsheets. But that's a sample. All right, put receipts back in the envelope each month after you record them in your columns, and put them in with your bank statement and your credit card statements. So you have all your records there, and that month, that envelope has the month and the year on it. And take the one out of your car, put them in one envelope. Don't put them in two separate ones like you purchase your car versus in your home office. Put them in one envelope, seal them up, make sure the month and the year are on the envelope, keep the envelope. There you go. You just have all your records kept. You got one record for your column report, and also you have all your receipts kept in one envelope. At the end of the year, remember you already have your column ledger handy. At the end of the year, you just bind all these envelopes together and you store with a copy of your ledger. So you have them all in one, bound in one, put a big rubber band around them. Congratulations, you just did all the record keeping you need as long as you keep those envelopes. Remember, the goal here is we just want you an easy way, an easy method to track and prove your deductions. The purpose of this course is definitely not to become an accountant. We just want you to minimize your taxes. That's why you're taking the course. And check the course library if you're interested in more bookkeeping, as I said earlier. We are in the planning stages. We may have some classes up on this to help you do better record keeping or some basic bookkeeping, and maybe even have a QuickBooks class or two for you. All right, keeping records. So here we go. Records are essential to proving your deduction. Electronic copies are okay, but they crash. So if you've ever had a computer crash and you have all your records on that computer, guess what? They crash. Paper copies, on the other hand, they're good, but they can be lost or destroyed. So the best practice would be, to me, would be to scan your statements in Ledger, keep an electronic copy, make sure that electronic copy is backed up, say with Carbonite or some other Dropbox, I don't know what you use, but something like that. So at least you have a backup, and then also keep your physical envelopes we discussed earlier. All right, here's a big question we get all the time. How long should you keep your records? Well, the IRS generally has 3 years to audit returns and assess tax. Okay, now, if it's discovered that you underreported your income about 25%, they got 6 years. For fraud or you never file a return, it's forever. So if you never file a return, be audited. There's no statute of limitations, which is what this is based on, until then. So what we want you to do, there's a very simple answer. Keep your records as long as you can keep them. I would suggest at least 7 to 10 years. It may be a burden, but just put them in a box somewhere. Keep them in one location. Some folks will tell you to destroy them after that. I would just keep them as long as you can. And that's it for the record keeping section of our course for real estate agents. I'll see you in the next section.